Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here, your host for this week under our new rotating host format. Please be joined by Tom Shipp. And Tom, we are going to talk a little tech today. How are you?
I'm doing well, Jeff. Thanks for having me and pleased to be back on.
Yes, you've been on more recently than I have. But there's no doubt that the topic is going to be tech related, whether we talk about AI or we talk about earnings season or we talk about why the stock market's doing so well. No matter what you talk about, it all goes back to tech. That is certainly a topic that all of you are interested in, I am sure. So here's our agenda for today. Tom and I put together kind of 6 key questions/topics to frame the discussion. So we'll start with just a really high level on earnings season so far. Specifically, where are we in the capital cycle? What does it mean that technology is becoming less asset light? Free cash flow deserves more focus. The capital cycle playbook. Where does the economic surplus from AI flow? And then lastly, how do we think about the concentration within the ecosystem? And how does that increase the risk? So there are 6 topics. Let's real quick, Tom, I want to get your thoughts on earnings season. It has just been incredibly strong. Of course, we'll leave the details on tech to the rest of the discussion, but I mean, what do you make of this? 27% earnings growth for the S&P 500. Tremendous.
Yeah, no, it's been quite impressive and definitely been driven a lot by growth. By tech. Sorry, the last time we were on the pod, I talked with Adam Turnquist about some of the interesting tidbits coming out of earnings season, and particularly how the revision cycle for 2026 numbers really spiked up after the conflict in Iran started, right? So the thing that was the macro headline that was driving the markets down during March was actually coming at a time when earnings revisions were going up, and those earnings revisions were driven, by, as one might expect, energy, right? Because the underlying commodity spiked up, but mostly being driven by tech. And this was somewhat perplexing because the overarching story of, AI and data center capex, et cetera, hadn't really changed. It was as if, the analysts on the sell side had to kind of woken up and started revising their numbers. Maybe it's their conversations with companies. So the earnings season really reaffirmed what was already going on, and it really drove, 1Q numbers looked very strong, like you said, over 20% year-on-year growth. And then, with the 26 revisions, spiking up, it's been pretty interesting to watch. And it goes to show that this market's, drive upwards hasn't just been driven by hopes and dreams, if you will. It's been driven by fundamentals.
Yeah, it hasn't just been tech. The Mag 7 has driven about 55% of that earnings growth. The median S&P 500 company grew earnings 12%. That's pretty good. Certainly the easy comparisons to the first quarter of 2025, when we were kind of dealing with tariff angst, at least toward the end of that quarter, certainly set us up for some really strong growth rates. So yeah, growth has been very, very strong. Certainly tech, the biggest story. And you mentioned revisions. The fact that earnings estimates for the next 4 quarters are up another 3%, that's been a continued pattern, right? Over the last several quarters, the spending numbers just keep going up and up from the big AI hyperscalers. So let's use that as our kind of lead into these 6 topics. So Tom, where are we in the capital cycle? Right, when we started the year, we thought we'd get maybe 550 billion ish in hyperscaler capex. Now it looks like that number could be well north of 700 billion. So clearly right now, those fundamentals are really strong, but but what should we be watching to kind of gauge where we go next?
Yeah, I think like I said, the fundamentals are real, and I think we're kind of shifting from a mindset of investors questioning the demand. I think we're well through that. We know the demand is there. The demand is real. Now we start to get to a little bit of like, will the returns on the incremental capital, right, the excess capex that everyone is spending, will the returns on that incremental capital be attractive enough to support underlying returns on equity. And I think that the big thing to start to watch is, and this is kind of an interesting read through on some of the individual companies that have reported, is that a lot of the capex being spent now is because that demand is right in front of them, right? It's supply constraints are there, the demand is right in front of them. They've got data center demand lined up, so as soon as they spend the money, they can turn around and rent that out to customers. Whereas if you had other companies that maybe weren't in the selling of compute, right, they're building data centers but they're not selling that space, those companies have been I'd say put in the penalty box a little bit, and then haven't seen as much stock appreciation over the last 3 to 6 months. So I think we are getting to a place where investors are starting to look more for what are the returns on AI and the capex, as opposed to just, oh my gosh, there's so much capex and demand here in front of us. Is it real? Is it not?
Yeah, that next phase will be really interesting to watch. It's very early in this cycle where we're seeing companies actually show value. Actually, speaking of early, I think a lot of people talk about what inning we're in. I just put together a chart of the Chat GPT era from 2022 of the NASDAQ and overlaid it against the NASDAQ from the late 90s, starting with essentially the birth of the internet, 1994 with Netscape. And back then, the NASDAQ essentially was a 10 bagger. So far this period, we're only about a 2.5 bagger, a little more than that. So we are, based on just that simple analysis, early innings for sure. So let's go to our next topic, Tom. Tech is becoming asset heavy. So, what does that mean for how you think about valuations?
This is something that is starting to get more attention paid to it. And the easiest way to think about this from well, how do I measure this, right, is I just like to look at a simple calculation of revenue divided by capex, right? So or said another way, how much of a company's revenue are they ultimately spending in their capex numbers? And so if we go back to even 2023, so actually still in the Chat GPT era, if we take the hyperscalers, including Meta and Oracle, the companies were spending about 11% of the revenue they generated in capex in the same year. So the estimates for 2026, right, so implied revenue projections and implied capex projections, are up over 40%. So four turns of increased capital intensity, just meaning that they're now spending that much more money in property and plant, right? Data centers, hard assets that they have to spend cash on now and have to depreciate over their life cycle to generate the revenue and ultimately profits on that revenue. So to take it back to a high level, when you think about this, right, your companies such as whether software based or maybe a search, a communication services name such as Google, these were typically asset light businesses that had high returns on the capital that they put into the business. And so they would be particularly rewarded with high valuations because of you build it once and you sell it a bunch of times, that kind of mentality. Well, now if we're getting into an era where these tech companies are more asset heavy or capital intensive, you might have to start thinking about that more in terms of A, the cyclical aspects of it, and B, just the amount of returns you're going to get on that capital. And so you would think look more like almost like a utility, right? With obviously higher sales growth, but a utility or an infrastructure type play. And so it's something that we look at quite frequently and think about from the perspective of how to value these companies based on their returns on equity.
Yeah, the question is how long will they remain capital intensive, and what does the trajectory look like after peak spending? We could do a whole bunch of podcasts just on that, but so we'll leave that. That's not even one of our 6 topics. So the topic 3, free cash flow, deserves renewed focus. It's related to what you just talked about, right? Essentially, all the free cash flow is being spent to actually build out the AI capabilities. So are there any other implications other than the fact that maybe valuation should be kind of pared back? Are there any other implications of that?
And I think this kind of ties into the prior point that we just made on the capital intensity is at the end of the day, whether you're looking at a shorthand of valuation using multiples, or if you're projecting out cash flows into the future and discounting them back to today, that's ultimately what a business is worth. And so you have to take in consideration whether, and I think that's the big question, right? The $64,000 question is what is the timeline? Like, is this a spend a lot now and then okay, they'll go back to being asset light and they can work off of this asset base that they've built and generate returns on the assets that they're creating now and don't have to kind of continually reinvest in the business? Or is this a new paradigm where they're just always going to have high spend, right? Because what that means is, as you're discounting out those future cash flows, if you have to continually reinvest so much in the business, you're going to have less free cash flow available back to the company, whether that's for further reinvestment, share buybacks, dividends, what have you. And so that's ultimately how you value the business. So that's a hugely important piece when we think about looking at free cash flow instead of maybe just pure earnings. Now, over time, they're gonna start to look the same if the spend levels remain the same. So I think ultimately we like to look at free cash flow multiples or free cash flow yields, just so those have had better predictive power over long periods of time. And that again comes back to, that's the question: are they spending a lot now and won't have to in 5 years, or are they just becoming ultimately more asset heavy and therefore the cash flows will always be reduced? Because at the current moment, the hyperscalers are trading at very, very high free cash flow multiples, whereas their earnings multiples don't look as high because they're able to stretch the spend over a longer period of time.
Yeah, that's right. I mean, just as an example, tech is trading at 26 times 2026 estimates. That's not even forward. That's current. That's a pretty low number. Even if you go to comm services and consumer discretionary, where the rest of the hyperscalers are, you're still looking at 30 times and under. And these companies are growing really, really fast, and they're really big. So if you use simple analysis of just PE and earnings, these things look cheap. But that's a great point, Tom, that on free cash flow, they look pretty expensive. But again, I always go back to the metaverse example with Meta, where the market said they were spending too much, so they pulled back. And essentially they got back all of the valuation impairment that they experienced as a result of that experience. The same thing could happen again, maybe not as dramatically and maybe not in as short of a time period, but we are going to see the market eventually probably push back on all this spending, and valuations certainly move around in both directions as we figure out what this cycle looks like in phase 2, phase 3, phase 4.
Yeah.
So let's move on to the capital cycle playbook, as I think you've dubbed it. It's essentially sparks the question of whether we're seeing companies pull forward purchases, right? Essentially like hoard, which would imply that you're seeing stronger growth now and weaker growth later. What's your sense of what's going on there, Tom?
Yeah, I think that's an open question whether that's happening. Like we've heard management teams at the big three hyperscalers, Microsoft, Amazon, and Google, speak to the fact that the demand is there for every dollar effectively that they're spending. So that would maybe say, oh well, maybe they're not pulling anything forward, but their end customers could be, whether it's a still private open AI, Anthropic AI lab, right? Or even just core enterprise customers, your typical Fortune 500 S&P constituent, they could be ultimately saying, hey, we need more cloud space, whether we have something to do with it right now, we're going to go buy it. So maybe it's the end customers who are pulling for demand. We don't completely know if that's the case or not, but I think at the higher level with the capital cycle framework is just thinking about any capital intensive business that goes through spending cycles, right? So you can, let's use the energy sector as an example of this. And you see this time and again where oil prices are high, capital flows into the industry. There's a bunch of, additional capacity added, whether it's rigs, whether it's offshore platforms, whether it's frac crews, et cetera. And ultimately, you overbuild, there's too much supply, too much oil is produced, that causes a glut in the market, oil prices go down, and then that supply starts to get either retired or scrapped or what have you, and you begin the capital cycle all over again. Now, typically, this has happened in various industries, including semiconductors, right, which we can speak to, but the idea is the same. Too much capital flows in, you start getting, that pull forward, you get into bidding wars for like the assets that you're spending on, all that goes, and then ultimately there's too much supply, right? And the same thing happened in the .com period with laying fiber in the ground, right? That the big story that everyone always quotes is we built so much fiber lines that didn't end up getting used it took 20 years for the bandwidth of the internet to finally catch up to how much was laid in that period of time. So yeah, I'm of the mind that, since this is becoming a more asset intensive business, the data center build out of compute for AI is that it ultimately is a capital cycle behavior. And you just have to kind of continue to watch where that, and that's not a bad thing, right? It's not saying good, better, and different. It's just that these are hard assets. There is capital flowing in, there is demand for it currently. And so we just had to keep an eye on, when we may be getting to a point of overspend and oversupply of all these assets.
Yeah, I think we're aligned on this, Tom, that there will be overbuilding at some point. It's just a question of how dramatically overbuilt we get, and then what, how much pain maybe the market has to feel down the road as we recalibrate. But based on the growth of these companies so far, again, it's very early innings in this whole cycle. But based on the growth, I mean, just look at the Mag 7 earnings growth in Q1, 56%. Right. And you can certainly all look up the private companies and see how fast they're growing. Clearly, the demand is there. This is not, I like to quote Field of Dreams, right? If we build it, they will come, right? Well, in the late 90s, they built it, and then it took decades for them to come. This is much different, a much different scenario, right? Where they've already arrived, right? There's fans watching the game, and then they're building the field. So that's how I would think about this. This demand is there. That doesn't mean it'll always be there for these dollars that are being spent, but certainly for now it is.
A good point you brought up too, just real quick, is what we're seeing too is some of the bottlenecks are slowing down what demand is there right now, and we're not even able to supply the hard assets, the data centers, right? So some of these bottlenecks are actually slowing down the build out, and therefore that may actually elongate the cycle. And this was a good point you brought up on one of our strategic and tactical asset allocation committee meetings, was that the fact that there are these bottlenecks may actually elongate the cycle.
Yeah, that's right. And then the dollars are going up partly because just of shortages and short-term inflation and prices, right?
Yeah.
It's not necessary. This latest leg up from, call it 680 billion in capex this year from AI up to 720 or 730 or wherever it is at this point. A lot of that is just higher memory prices. So
Yeah.
got to consider that too. That it doesn't look, it's not quite as dramatic of a leg higher as it might seem, which is important to keep in mind.
Yep. Good point.
All right, so let's go next to who's going to benefit from this, right? Is the what you've called, I think, in our notes, a surplus, an economic surplus from AI? Is that going to flow downstream? In other words, should we be playing the picks and shovels folks building this, or in the end, are the best opportunity is going to be in the folks adopting this and generating the margins from productivity gains?
Yeah, I where I stand on this is right now, obviously the picks and shovels are where all the benefit is accruing in terms of earnings, right? And profits, as you mentioned, alluded to with the memory providers, with the high compute GPUs, et cetera, all the chips, that's very much in the picks and shovels, as well as some of the more industrial tech, hardware type industries as well. Ultimately, though, I think, and I think that's where we move from the capital cycle piece, right, the picks and shovels, into a transformative technology that does, increase productivity and increase output from the economy writ large. And the way I think about this, and this is a longer tailed event, is that in general, when we have these transformative new technologies, whether it's railroads, electricity, the internet, is usually the economic value typically tends to accrue to the users of it, right? So the how many railroads went bust, right? But everybody, benefited from being able to cross the country in a train rather than on a horse and buggy. So I think ultimately that is what will happen. And but right now we're so early, right? Even if you just want to look at hard numbers on the actual monetization of AI, right? Those numbers right now are, estimates vary from as low as 25 billion to 70 billion dollars annually is what we could actually tag to, pure monetization of AI. That's obviously a fraction of what's being spent on the hard assets of the data centers and the chips. So we're very early, and right now that value is accruing to the picks and shovels. Long term, I believe it will accrue down to users and folks like you and me, and whether it's knowledge work, whether it's healthcare, whatever it may be.
Yeah, and that's where you are talking about well beyond 2027, right?
Yeah.
I think at this point maybe we have visibility into 2027, but beyond that, it's really hard to say. But yeah, based on what I'm hearing from tech companies and folks that follow this stuff more closely than I do, it's going to take more time before the market really becomes skeptical about the payoffs. Right? It will at some point, probably. In other words, expectations, it happens every cycle, right? The hype just goes a little too far, and then the actual reality just doesn't quite measure up to that level of hype. So we'll probably get there. I would just argue that it's going to be much more gradual than it was in the late 90s and early 2000s, just because of the amount of waste, the amount of capital that found its way, essentially was just lit on fire. We're not going to have quite the extreme cycle, I don't think, this time. And that's consensus. I'm not telling you folks anything you probably didn't already think yourselves. So let's go to the last point here, Tom, before we wrap, and that's concentration. So how should investors think about that? Because, of course, we just have a very small number of companies building out all of these capabilities. And, a lot of folks are saying that the stock market rally is not really sitting on the strongest foundation because it's been so narrowly led. So how do you think about those things?
Yeah, I mean, we've been talking about this for a few years now, and I think we're we are actually starting to see, like we mentioned, there are opportunities that arise within, whether you're just playing between the Mag 7. But we're starting to see newer names that are starting to participate, whether it be across semiconductors, whether it be in that more industrial and tech hardware space. So the benefits are accruing maybe beyond that hyper concentration, but the theme is still pretty concentrated, right? And so, I think especially with so many folks, passively investing in indexes, whether it's the S&P 500, whether it's the NASDAQ 100, you kind of want to have a finger on the pulse of what you own and what's going on. And I think over the long term, indexation has shown that, it's, generally after costs, the way to go. I think that for more tactical folks and maybe folks who are looking to, make either the thematic ETF investments or individual securities, there are going to be those opportunities, and so I think that concentration is a risk to just know what you own when you're making these, and this applies even to individual country indexes as well. I was looking at the South Korea index. I think is 50% to stocks, and big surprise, they are semiconductor manufacturer companies. So yeah, I think that it absolutely, like we noted, that it can amplify risk, because you could have just the Mag 7, kind of go through a drawdown, and it's going to bring down the entire index. So I think that's just something for folks to keep an eye on.
Yeah, this concentration issue, at least in the S&P 500, for example, has been a concern now for the past couple of years, right? And actually, you could even trace it back maybe as far back as 2021, coming out of COVID. The picks and shovels that we talked about, right? The chip makers that probably are going to be a little bit more cyclical and have more ups and downs, but the companies that adopt AI and use it profitably are not going to experience the dramatic ups and downs. So there will be a broadening out. Hopefully it's kind of a gradual rotation like we've seen over the last, call it 7-8 months, where the Mag 7 works and then it doesn't, but then we broaden out and the rest of the stuff picks up the slack, and vice versa. It's just gone back and forth, but the rest of the market will benefit from AI adoption. There's no doubt in my mind. It's just going to take time to kind of sort out who's going to win and by how much, and what the eventual earnings benefit is from that AI adoption. Because you're listening to companies talk on conference calls, sure, almost all of them are mentioning AI, and almost all of them are saying that they're going to use it to their benefit in some way, but the tangible examples of benefit are a little bit harder to parse out. So that's something we'll increasingly be doing over the next several quarters for sure, and I'm sure we'll have more examples of the power of AI then, and then especially in 2027. I thought when we wrote our 2026 outlook late last year, in my mind, I had 2027 as the year of AI adoption. That still looks like a pretty reasonable timetable to me. I think it's going to really ramp up. So
yeah, there's a interesting McKinsey report out that just talks exactly about this, and likely talking their own book a little bit, because they are selling consulting services and how to rework one's organization for the AI era. But it called out that entire workflows may have to change, like the way we think about so much of the work that is done has to change, and that's just going to take time.
100%. So we'll be with you along the way. So Tom, look forward to future discussions with you on this topic, because you, as head of equity research at LPL, are listening to companies probably as much as any of us. So thanks for continuing to bring the insights that you garner from corporate America. So with that, we'll go ahead and wrap. Thanks everybody for listening to LPL Market Signals. We will be back with you next week. See you then, and take care.